Investing like Warren Buffett or like a value investor means being able to find promising companies that sell at a lower price than their intrinsic value. The only way to properly invest in the long term is by being able to read and interpret financial statements. In this particular video, we're going to talk about the second most important financial statement, which is the balance sheet. Are you ready? Let's go! What's up people, my name is Rick and in this video we're going to talk about the interpretation of balance sheets as a value investor. Assuming that you've watched the first two videos and you know everything about the durable competitive advantage and the income statement, let's focus now on the balance sheet, and to do that, just as we did in the other videos, let's use the statement from the Coca-Cola company as an example. From the 10K of Coca-Cola, let's click this time on consolidated balance sheets, and we'll get a table which is divided into assets, liabilities, and equity. Now, balance sheets, unlike income statement, are only for a set date, not for a period of time. When we analyzed the income statement in the last video, we saw that the income statement draws a picture of a whole period, like a quarter or a year. The balance sheet works differently, and it's like a photo of an instant of the company and draws a picture of the assets, the liabilities, and the equity of the company in that particular instant, which usually is the end of the fiscal quarter. So as we said, the balance sheet is divided into assets, liabilities, and equity. Assets are the items that you own that can provide future economic benefits, while liabilities are everything that you owe other parties. So in short, assets put money in your pockets and liabilities take money out. Assets are basically cash and the properties that a company possesses. Liabilities can be, for example, the money that a company owes to a bank which financed their business, and you can't imagine how much money almost every company owes to banks. Now, if you imagine that you have a certain value of assets, which is a good thing, and a certain value of liabilities, which isn't, the difference between the two is the so-called equity or shareholders' equity. Assets are divided into current assets and all other assets. Current assets is made up of everything that is cash or can be converted to cash within a year. Some typical items of assets are cash and equivalents, short-term investments, account receivables, and inventory. Other assets or long-term assets are everything that cannot be converted into cash within 1 year, like long-term investments, property, plant and equipment, goodwill, and so on. So first item, cash and equivalents. This is exactly what it says it is. Cash or equivalents such as 3 months treasures from the bank or other liquid assets. High cash can mean two things. One, the company has a durable competitive advantage and makes a lot of money, which is good. And two, the company has just sold a business or tons of bonds, which is not good. Having a low amount of cash, on the other hand, is basically always a bad thing. Traditionally, companies have been using excess cash to expand operations, invest in new businesses, buy back their stocks, or pay out cash dividends to their shareholders. Quite often, though, they just take it for a rainy day. If a company has a lot of cash in the balance sheet and low debt or liabilities, chances are the company will survive future problems or crises. To understand what is generating the cash for the company, you can look at the last 10 years of the balance sheet, for example through QuickFS.net. You will see if the cash has been generated in one time or whether it was generated every year by the business operation. Always look for consistency, and if you found a company that has a lot of cash, no sales of assets, a little or no debt, then probably you find a good company with a durable competitive advantage. Now, after cash, let's see what accounts receivable are. Accounts receivable is money owed to the company. When you buy something on Amazon and Amazon allows you to pay 30 days later, in that period of time, Amazon still hasn't gotten the cash from you. Therefore, that amount is stored as receivables. If gross sales increase more than receivables, then the company might show some kind of competitive advantage. When you try to identify a manufacturing company with a durable competitive advantage, look for inventory from the balance sheet and net earnings from the income statements, and check if they are on a corresponding rise. This indicates that the company has found a way to increase sales, and the increase in sales has called for an increase in inventory. But if the inventory ramps up in some periods and drops down in others, that's probably not good, because that means that the company works in a competitive industry. Prepaid expenses give us little information about the durable competitive advantage, but just to clarify the meaning, companies sometimes pay for goods or services that they will receive in the near future. You can see prepaid expenses as the opposite of accounts receivables, because in this case, it's a company itself that paid for the goods or services and it's still waiting to receive them. Now, total current assets play an important role in financial analysis, and the comparison between the current assets and the current liabilities is really important to understand if a company can meet its short-term debt obligations. Now, imagine if a company has a lot of liabilities and not enough assets. If the company is in a crisis, or if they need to pay back the money from their liabilities in the short term, they might not be able to pay their money back, and this can lead to bankruptcy. Therefore, analysts develop the current ratio, which is calculated by dividing current assets by current liabilities. A current ratio above 1 is considered a good value, but it's important to notice that some companies with a durable competitive advantage may have a current ratio that is below the magical value of 1. This is because these companies earn so much every year that they don't need to have so many assets to cover for their short-term liabilities. Therefore, they prefer to pay out dividends or buy back stocks, both of which reduce the value of current ratio to below 1. Now, after the current assets, we have all other long-term assets. One of them are other investments, which are long-term investments such as stocks, bonds, and real estate. Then we have other non-current assets, which are assets with a life of longer than a year, which didn't make it into particular categories that you see here, like property, plant and equipment, trademarks, goodwill, and so on. So this position doesn't tell us much. Now let's see property, plant and equipment. For Buffett, not having them can be a good thing. Companies that don't have a durable competitive advantage often face constant competition, and that means that they have to update really often their plants and equipment in order to stay competitive. Goodwill is an intangible asset that is created when a company acquires another company for a price greater than its net asset value. So if goodwill increases over the years and you know that the company is acquiring other good businesses, then it's a good thing. If goodwill stays the same, then it might mean that the company is not acquiring businesses, or that it's acquiring businesses that sell at a price that is lower than their book value. And this is not a good thing, because usually when a company sells for a price that is lower than its book value, it means that either the company is in a financial crisis or they don't have a durable competitive advantage. Add current assets to all long-term assets and you get the company's total assets. Now, there is an important ratio that I'd like to introduce to you. It's a so-called return on asset ratio, ROA, that determines how efficiently the company puts its assets into use, and it's calculated as net earnings divided by total assets. The net earnings come from the income statement and the total assets from the balance sheet. Now, while having a high ROA is important, a company with an excessively high ROA might indicate a vulnerability in the durable competitive advantage. This is because the value of the company is calculated also through its assets, and if a company has a lot of earnings but not enough assets, it's going to be easy for other companies to take it over and buy it. So we talked enough about assets, let's focus now on liabilities. Just as for assets, there are two types of liabilities, current and long-term. If we subtract the liabilities from the assets, we will get the net worth of the business, which is the shareholders' equity. Let's start from the current liabilities. They are the debts and obligations of the company that are coming due within a fiscal year. The first we see here in the Coca-Cola 10K are accounts payable. Accounts payable is money owed to the suppliers that have provided goods or services to the company on credit. Accrued expenses are liabilities that the company has incurred but has yet to be invoiced for. In this Coca-Cola 10K, the short-term debt is divided in two voices, loans and notes payable and current maturities of long-term debt. In general, short-term debt is money that is lended to the company and is due within a year. When it comes to investing in financial institutions, Warren Buffett usually stays away from banks or financial institutions that have a lot of short-term debt compared to the long-term debt. The second item, which as I said is also a short-term debt, is called current maturities of long-term debt, and is basically long-term debt coming due within the fiscal year. As a rule, companies with a durable competitive advantage require low or no long-term debt to maintain their business operations, and therefore have low or no long-term debt coming due. So these are all the current liabilities, and as we discussed before, if you divide the total current assets by the total current liabilities, you get the current ratio, which indicates if a company can meet its short-term debt obligations. Now let's move on to the long-term liabilities, and we start with probably the most important one, the long-term debt. Companies with a durable competitive advantage often carry little to no long-term debt. This is because they are so profitable that they are self-financing when it comes to investing into expanding operations or making acquisitions. So always look at 10 years of data and look for consistency and low values of the long-term debt. Moreover, the company should consistently have enough net earnings to pay back their long-term debts within a 3 to 4 years period. Summing up all current and non-current liabilities, you get the total liabilities. There is also another important ratio which is used a lot that is called the debt to shareholders' equity ratio, which is basically the ratio between total liabilities and shareholders' equity. Historically, it has been used to identify whether or not a company uses debt to finance its operation or equity. Companies with a durable competitive advantage usually should show low values of total liabilities and high values of shareholders' equity. But if a company is really profitable and has a durable competitive advantage, they don't need to have so much equity to get the job done. So these companies are so profitable that they use all the return earnings to buy back their stocks, which helps bring down the equity value. But if the equity decreases, then the debt to shareholders' equity ratio increases and makes the company look like they have a lot of debt. But there is a solution to this. In order to avoid falling into this trap, you can recalculate the ratio adding up to the shareholders' equity the so-called treasury stock, which is the stocks that the company buys back using the return earnings. This is called treasury stock adjusted debt to shareholders' equity and is calculated as total liabilities divided by shareholders' equity plus treasury shares or treasury stock. When you subtract all liabilities from all assets, you get the net worth of the company or shareholders' equity, which is also called book value of the business. Total liabilities plus equity must equal total assets. There is an important ratio, which is the return on equity, ROE. It's calculated as net earnings after tax income divided by shareholders' equity. The return on equity ratio shows the management's efficiency in allocating the shareholders' money. In other terms, it shows how much money is returned to the shareholders in the form of earnings as a percentage of the money invested or retained in the company. A high return on equity means the company is making good use of the money they are retaining. Companies with a durable competitive advantage usually have higher than average return on equity compared to the industry. So always compare many companies within the same industry. Good companies usually have a stable value of around 30%, and companies that work in an industry that is really competitive, like airlines, can have a return on equity of around 0 to 10% or sometimes even negative. There are some companies that are so profitable and good, like some tech companies, that they don't need to retain any money at all and invest all of it for the expansion of the company. This results in some cases and some years in a negative return on equity. To avoid mistakes, you should always look for a company that has a history of strong earnings when you find a negative return on equity. Now, the shareholders' equity consists of different elements, for example, preferred and common stock, capital surplus, and so on. We're not going to discuss every term here, but we will focus now on retained or reinvested earnings and treasury stock. When a company has earnings, they can usually do three things with them. They can pay them out as dividends to the shareholders, they can invest them for the expansion of the business, or they can buy back their stock. Reinvested earnings or retained earnings are the part of the profit that is reinvested back into the company. Always look for growing return earnings. The company can also decide to buy back their own shares, and this is found in the so-called treasury stock item. The presence of the treasury stock is really important to understand if the company has a durable competitive advantage or it doesn't. Treasury stock, although they're an asset, they're reported as a negative value. Therefore, they decrease the shareholders' equity, and this in turn automatically increases the return on equity ratio, which was net income divided by shareholders' equity. So in order to obtain a comparable value of return on equity, there is a way you can adjust it using the treasury stock. Add treasury stock to the shareholders' equity and use this as denominator to the net income instead of the only shareholders' equity alone. So the adjusted return on equity will be net earnings divided by shareholders' equity plus treasury stock. So to summarize, in general you should always look for companies that have more assets than liabilities and that have little or no long-term debt. Now there are many small nuances and details to this, so I try to give you all the possible information that I could in a single video, hopefully without overwhelming you. To make it easy, I also prepared a 2-page summary that you can download from the link in the description below. Of course, it's for free, and here you will find all the information, all the important information from today's video. If you found any use in today's video, don't forget to subscribe to my channel, hit the like button and ring the bell so that you will be notified when I'll post next week my next video that is going to be about the cash flow statement. So I wish you a great day, hope to see you in the next video, and well, take care of yourself. Ciao!